Invented in Japan, three-line break charts ignore time and only change when prices move a certain amount, similar to point and figure charts. Three-line break charts show a series of vertical white and black lines. The white lines represent rising prices, while the black lines portray falling prices. Prices continue in the same direction until a reversal is warranted. A reversal occurs when the closing price exceeds the high or low of the prior two lines. Before looking at construction details, a couple of clarifications are in order. First, the black and white bars on the price chart are called lines. Second, line changes are based on closing prices, not the high-low range. Third, three-line break charts evolve based on price, not time. The first chart below shows 85 candlesticks or trading days from March 21st until July 20th. A three-line break chart condenses this price action into 44 black and white lines. This technique filters the noise to focus only on price movements that are deemed significant. Each new closing price produces three possibilities. First, a new line of the same color is drawn when the price extends in the same direction. Second, a new line in the opposite color is drawn when the price change is enough to warrant a reversal. Third, no new lines are added when price does not extend the trend or the change is not enough to warrant a reversal. The high or low of the prior two lines sets the reversal point. If the most recent line is black, down, then the high of the last two lines marks the reversal point. A close above this high would call for a white line to denote a price reversal. Keep in mind that only the most recent line must be black, down. The line just before this black line can be white, up, or black, down. It is the low of these two lines that dictates the reversal point. The chart on the screen shows Dell Inc., Dell, with three two-line reversals, the first two formed with two black lines, while the third formed with a white line and a black line. The horizontal red lines mark the reversal point, which the white line exceeded to forge the reversal. If the most recent line is white, up, then the low of the last two lines marks the reversal point. A close below this low would call for a black line to note a price reversal. Keep in mind that only the most recent line must be white, up. The line just before this white line can be white, up, or black, down. It is the low of these two that decides the reversal point. The chart below shows United Parcel, UPS, with three two-line reversals. The first and third reversals feature a black line, white line combination, while the middle reversal shows two white lines. The horizontal green lines mark the lows or reversal points, which the subsequent black line exceeded to forge the reversal. As the name implies, the three-line break chart is all about breaking three lines. Two-line reversals can occur in a trading range or as a continuation of the bigger trend. A three-line break, on the other hand, denotes a stronger move that can signal a trend reversal. A bullish trend reversal occurs when three black lines form and a single white line breaks the high of these three lines. A bearish reversal occurs when three white lines form and a single black line breaks the low of these three lines. The chart on the screen shows the Russell 2000 ETF, IWM, moving from a downtrend to an uptrend and back to a downtrend. The downtrend starts with the first black line on June 6. A new black line will not be drawn unless prices move below this low. Notice how the date moved from June 6 to June 8 without a line in between, shown on number 1. June 7 is not shown because prices did not move enough to justify a new black line or a white reversal line. Prices moved to a new low on June 8 to justify a new black line. This downtrend continued until the closing price exceeded the high of the prior 3 black lines, shown on number 2. This 3-line break signaled the start of a new uptrend on June 21. Prices traded within the range of this white line until June 28, shown on number 3. On June 28, 5 trading days later, prices exceeded this high to justify a new white line. Prices continued higher the next 6 trading days as new white lines were added each day. The uptrend reversed when prices moved below the low of the prior 3 white lines, shown on number 4. This 3-line break justified a new black line to signal the start of a downtrend. 3-line break charts produce clear reaction highs and lows upon which to base resistance and support. Chart analysis works the same way as on a bar or candlestick chart. The chart on the screen shows Constellation Energy, CEG, with a clear resistance zone marked by 3 reaction highs. The stock broke resistance with a surge in early April and continued much higher. Also, notice that a falling flag or channel formed in February. Classic patterns are also viable on 3-line break charts. Double bottom, double top, head and shoulders patterns, triangles, and others can form on these charts. The chart on the screen shows Vulcan Materials, VMC, with a large symmetrical triangle forming from January to May. The stock broke the lower trend line and support with a sharp decline in early May.